We'll be discussing common chart patterns in this video lesson. As a trader, you should be familiar with the typical chart patterns that occur on a daily basis, as it is both a good way to get into trades and to avoid bad ones. The chart patterns we are about to discuss can be found on all types of charts, from short-term intraday minute bar charts to long-term daily, monthly, or even yearly charts. Therefore, no matter what style of trader you are, it is important to understand the information these charts are telling you. Being able to routinely identify distinct patterns of consolidation in charts throughout the trading day will raise your level of awareness and improve your probability for success. Make sure to add the following chart patterns to your trading arsenal. Okay, this first type of pattern we will discuss is the flag pattern. The flag pattern is the most basic form of a continuation pattern, which occurs when there is a significant vertical or parabolic move in the price followed by a period of tight consolidation as some traders decide to take profits while others add to their positions. It is common to see a decrease in volume during this consolidation period as price action bounces around in a horizontal to sloping channel. Now, once the channel is broken, a successful breakout of a bullish flag or a breakdown of a bearish flag should occur on above average volume. It is important to note that unlike the other continuation patterns that we are about to discuss, if a flag has a clearly defined base, it can be used to build a position in anticipation of a breakout. So how should you trade this? Well, basically by entering in at the breakout or breakdown of the consolidation formed by the flag. In other words, buying the breakout of a bullish flag and shorting the breakdown of a bearish flag. Now, a flag is similar to a pennant and triangle, which are two patterns we're about to discuss, in that the entry point into the trade is at the breakout or breakdown from the consolidation. However, with a flag, there is also a trade that can be made prior to the breakout or breakdown. For example, let's say a stock makes a vertical move up and is followed by a period of consolidation, creating a bullish flag. If a clearly defined price is identified as a bottom of the consolidation, you can place an order to buy shares slightly above this price and place a stop directly below the bottom of the flag, thus creating an excellent reward to risk opportunity, as you would profit substantially should the trade break out and ascend out of its bullish flag pattern. Okay, the second chart pattern we will discuss is the symmetrical triangle. Symmetrical triangle patterns are continuation patterns similar to flags as well as pennants, which all occur after large moves in price. Now, it is common to see decreasing volume during the consolidation period as the triangle forms. However, as price breaks the triangle, volume should spike, confirming that the move is a legitimate one. The breakout itself has potential to move the entire range of the triangle from its highest to lowest points. So how should you trade this? Well, because there is no clearly defined base in a triangle, it is best to wait for a confirmed continuation breakout on high volume, as there can be numerous false breakouts in either direction, which most likely will occur on lighter volume. On a bullish symmetrical triangle, the breakout should be through the upper trend line of the triangle, and a bearish breakdown should be through the lower trend line. A breakout or breakdown should both occur on increased or heavy volume. Okay, the third chart pattern we will discuss is a pennant, which is another type of continuation pattern. The pennant pattern is essentially identical to a symmetrical triangle, with the only noticeable difference being the much shorter duration of the consolidation. In a pennant, the consolidation form may also be less visually definable than in a symmetrical triangle. However, similar to the symmetrical triangle, the consolidation should occur on decreasing volume relative to the volume during the initial trend. Moreover, the breakout of a bullish pennant or breakdown of a bearish pennant should occur on heavy volume. So how should you trade this? The best move is to wait for the breakout or breakdown on increased volume, as this confirms the continuing of the previous trend, as there is always the risk of a false breakout or breakdown. Now the fourth chart pattern we will discuss is a wedge pattern. A wedge combines the consolidating price and volume of a symmetrical triangle with the sloping trend of a flag pattern. Although it resembles a symmetrical triangle, it can be a continuation or a reversal pattern. A rising wedge is bearish, while a falling wedge is bullish, regardless of what the previous trend was. Now, similar to a triangle or pennant, volume should decline during the consolidation period as the wedge is formed, and spike in volume once the formation is broken. So how should you trade this? Since it is impractical to build a position while the wedge is forming because of a poor reward to risk ratio, traders should wait for a confirmed breakout in either direction, as they typically occur in the opposite direction in which the wedge itself is heading. As with all these patterns discussed so far, a surge in volume should accompany the breakout or breakdown of the wedge. Now, it is important to make a quick observation that with the symmetrical triangle, pennant, and wedge, all are formed as price action funnels into a tighter and tighter range until a break occurs. Therefore, make sure you understand how to recognize the differences between the three. Moving on to a head and shoulders pattern. A head and shoulders pattern is a bearish reversal pattern, most often occurring during an uptrend, while an inverted head and shoulders is the exact opposite, a bullish reversal pattern, which is most effective during a downtrend. A classic example of a bearish head and shoulders will begin with an uptrend occurring on above average volume, followed by a correction, the low of which forming the neckline. This subsequently puts the left shoulder into place. After forming the neckline, price will reverse and make new highs on lower volume. Then, a reversal of this move will test the neckline, forming the head of the pattern. With the neckline holding firm, price once again ascends and falls, forming the right shoulder. It is important to note that the right shoulder must be lower than the head, but not necessarily lower than the left shoulder. Now, the reversal of this final downtrend from the right shoulder must break the neckline, which then signals an official reverse in trend as volume surges. So how should you trade this? Well, believe it or not, traders should not be passive and wait for the pattern to form before entering. There are many opportunities to capitalize on moves caused by the head and shoulders with minimal risk. However, the optimal trade is obviously the breakout or breakdown through the neckline. Okay, the next pattern we'll discuss is a double top or bottom. Now, a double top is a bearish reversal pattern which occurs only at the end of an extended uptrend, while a double bottom is a bullish reversal pattern which occurs only after an extended price decline. The key to a double top is that the second top does not make higher highs, and in the case of a double bottom, the key is that the second bottom does not make lower lows. Furthermore, in a double top, the low of the first price correction, or first top, serves as the confirmation level, with a breakdown through the price, thus signaling confirmation of the pattern. So how do you trade this? It is common to see traders capture the move from the second top or bottom to the confirmation level as entry, target, and risk are known. For example, this is accomplished on a double bottom by buying near the low of the first bottom as it starts to reverse, with a stop loss directly below the low of the first bottom, and a sell limit order to exit near the confirmation level as the set target price. While this trade is easy to define, the true move is a breakout or breakdown through the confirmation level, as this is a much better reward to risk setup, as this will most likely also be affirmed by a volume spike. The final chart pattern we will discuss is a parabolic reversal. This type of pattern should be traded by only those with a true understanding of market dynamics, as you are literally fighting the trend in an attempt to pick a high or low. Basically, those who trade this pattern look to reverse a stock that has experienced a significant or parabolic move in a short period of time, which was most likely caused by news, earnings, or economic data directly affecting the stock. For instance, in a parabolic uptrend, price increases at a very rapid pace as buyers fuel momentum. Volume during such moves is noticeably greater than average but fade as the move nears its conclusion. However, it is important to note that it is possible for price to continue to rise even as the volume subsides. Now, the reversal itself in a parabolic uptrend occurs when selling pressure grows, causing price to decline while volume increases. A parabolic downtrend occurs when numerous shorts cover, which cause price and volume to increase. So how do you trade this? Simple, with extreme caution. This is hands down the most risky pattern to trade, as you are attempting to reverse a major move. With parabolic reversals, exits should be placed at new highs in an uptrend and new lows in a downtrend. But keep in mind, those exits can be violently breached by erratic price action. However, due to the extent of the move itself, these parabolic reversals can be extremely profitable. Furthermore, if implemented properly, parabolic reversals nicely adhere to the reward to risk parameters needed to warrant a trade. With that said, when trading this pattern, you must stick to your exits as losses can grow quickly. Furthermore, due to the risk involved, wait for the volume and price to confirm a reversal before entering. So to wrap things up, now that we've established the common chart patterns that are found all over stock charts every single trading day, entries and exits should be easier to identify. Furthermore, with set entries and exit points that most of these patterns provide, calculating your reward to risk ratios should become a whole lot easier to do. Remember that by being aware of what consolidation patterns are forming in stocks that you are watching will ultimately keep you out of bad trades and get you into good ones.